Thank you for being here today, Ryan.
Yeah, thanks, Jasper. Always great to be here. And, as you can tell, I enjoy talking about Equinox. There's a lot of great things happening.
Yeah, we got a lot to talk about. So let's start with maybe you could just introduce yourself and quickly tell us about your career.
I've been in the mining sector now for over 20 years, actually. This is it's shocking. And predominantly in the precious metal sector, I've worked very closely with uh, two people that have been quite successful in the sector. Blaine Johnson, who was the chairman of Caliber Mining, and Doug Forster is the lead director and founder of Caliber as well. So, two individuals that I've worked with in many different entities. A company called New Market Gold, which we merged and sold to Kirkland Lake Gold, which went on to do extraordinary share price returns just uh, just prior to it being acquired by Agnico Eagle. And prior to that, there was a company called that was also quite successful called Terrain Metals, which was a large copper gold development stage project that was going through permitting and fees in central British Columbia. The asset is known as Mount Milligan, and that was acquired by Thompson Creek, and of course, then was acquired by Centerra. So I've had the privilege of working at all different stages: exploration, early stage exploration, um, through permitting, through feasibility studies, raising extraordinary amounts of capital through equity financings. So it's been a journey, and this is the first time I've ever worked for a company of this magnitude. I've worked for many producers over my career, but of this magnitude with a diversified portfolio, we now have. I think we're teetering on 12 analysts that cover the company. So that in itself is a pretty significant full time job, reviewing models and going through all the income statement, the cash flow statement, the balance sheet, etc. But no, that's a little bit about my background, and I have a business degree. So most of the time, I've been involved in different levels of corporate development, marketing, IR related activities for companies. Starting companies, raising the startup capital, and really trying to see them through to some type of a transaction where all shareholders can benefit.
Since we our last interview, your share price has appreciated in value. Obviously, also the gold price has gone up quite significantly. But you have definitely outperformed the gold price. So you're right about Equinox having should have a re-rating. Could you give us some sense of the current valuation and also motivate why this is a good entry point or potentially a point to buy more?
But here, just a couple of interesting facts. Okay, um, January 2025 to through the announcement, through the deal with Caliber Mining, right to the close, Equinox Gold was up about 8%. So that's again January to June this year, 2025. The peer group was up 54% during that period of time. So it was interesting. There was a lot of pushback, it seems, on this deal, and there was a lot of uncertainty around Equinox and the company.
And
Um,
sorry to interrupt here, but could you just clarify or give some names in the peer group to who
yeah,
do you
of
consider
course.
to be your peers?
Of course. So in the peer group, we've got B2 Gold, we've got Orla, we've got Endeavour Mining, we've got Eldorado, Alamos, Torex, some Australian names: Evolution, West Gold, Lundin Gold, Kinross. So a pretty big basket of peers. And even when I look at the GDX or the GDXJ, both were up over 50% during that period of time. So interesting, right? Okay, the deal closes with Caliber Mining. There's a bit of a shift in management. So um, Darren Hall became the CEO of Equinox Gold. And remember, during that period of time, the gold price was up 26%, right? So 26%. We're not even outperforming the gold price, right? So that's, why own a gold equity if you're not going to outperform the gold price, right? So now I'm going to look at, let's call it July 1st to what is today? Today is 11/26, so let's put 26 in. So as of yesterday, we're going to run the same scenario and see where things land, right? And as of yesterday, the peer group from July 1 to yesterday, the peer group was up 68%. That's the peer average. So GDX up 55. The gold price is up 23%, less than it was in the first half of the year. Okay. Equinox Gold is up 141%. Equinox Gold is up 141% versus a peer group that's up 68%. So, I mean, there's been a shift in culture. There's been a shift in leadership. The gold price has not really catapulted more than the first half of the year. So I'm a tale of two halves. So when the deal closed, because there was a lot of opposition, a lot of pushback to the deal. A lot of Calibre shareholders, and I think even maybe Equinox shareholders as well, were kind of like, why we're doing this deal? Does it make sense? What are the benefits? We are starting to see some of the benefits of this deal. The scale, the majority of value coming out of Canada. Because remember, Greenstone was ramping up, but it was having some challenges along the way, right? It was. We know that in Q1, the expectation was not quite met for what the market had for Greenstone. And then we had just behind it Valentine coming on, still in construction. But it's interesting, right? So Ross Beatty, Darren Hall, Greg Smith, Blaine Johnson all worked very hard to get this deal done, because in this scenario, we all believe that by putting these companies together, you're going to create a better product for a broader shareholder base. And we are seeing the evidence of that with the ramp up of Greenstone, with the first gold, and then the commercial production at Valentine. And the re-rate is coming. And I think that there's a lot of opportunity here. And I'll give you another example. Actually, what I'll do here now is I'm going to share the screen for a second. So I'm just going to go to, here's a slide that shows a graphic that's really quite, this was as of November the 15th. So we update this very regularly with analyst numbers as they change and as share price changes. So we're looking at a price to NAV, which is a pretty typical metric in the mining space. You can see that Equinox is still not even trading at peer average. I think peer average is 1.13, right? From a diversified gold producer peer group. The enterprise value, so EV to ounce of production, the average is 14 plus, almost 15,000 per ounce. We're trading at 12, and it has come up a little bit, but all of the golds have come up as well. So if I reran these numbers again here today, the numbers would actually probably be very similar, because Equinox hasn't really, in the last 10 days, hasn't really outperformed the whole peer group. The whole group is rising. So it's still presenting an opportunity, right?
And what kind of gold price is assumed and discount rate are assumed in the when for PNAV here?
Because every analyst is a little different with a little bit different gold price. I think that most are now using about a 3,800 base to use the basis of which their research is on. So 3,800. Some are using 4,000 for 2026. So there's a lot of updated numbers here.
But long term prices are usually quite lower. They usually are quite a bit lower than next year's.
Absolutely, long term prices I think probably average sub 3,000 across the analyst space. The point is that all of them are equally reviewed based on the same kind of gold price assumption and analysis. We're using the street or the market consensus numbers to get these metrics, right? So still demonstrating an opportunity. Now let's take a look at this slide. Lots of different factors go into different evaluations and metrics, but here we're looking at the share price performance of Equinox Gold since 2022 to November 15th. And again, Equinox had been going through a period of time of investing significant amounts of capital into Greenstone. We were investing into Valentine, so it was a cash investment period. Now we're transitioning into a cash kind of harvest mode, deleveraging mode, but we had significantly underperformed the peer group. And what is our purpose of being here? Our purpose of being here is to add value and drive value, especially in the environment that we're in this gold price environment. You can still see EQX has underperformed the gold price. That's disappointing. That's disappointing. And there's a lot of reasons we could get into why or how and what, but the culture is changing. The path is clear. We need to deliver on our commitments. We need to take a disciplined approach to capital allocation. We need to delever our balance sheet, which is a priority for us, with 1.5 billion of debt, I believe 1.1, 1.2 of net debt. But we're in this type of an environment where we can very rapidly delever the balance sheet. So it's an exciting time. So that's why I believe we still present a pretty compelling opportunity for those that believe, hey, we're in a new paradigm. We're in a 3,500, 4,000, 4,000 plus gold price environment. And I don't know where the gold price will end up. I think we use something like a $3,000 or $3,200 gold price environment for the sake of looking forward at the budgeting processes. We have obviously sensitivity analysis, but like, for example, I just saw the other day, Goldman Sachs and many banks now, North American and international banks, would say something along these lines, but Goldman Sachs is at $4,900 is what they believe the average price of gold will be in USD for 2026. So, you plug in those numbers for 2026 for Equinox, it's shocking about how much cash flow the company will generate and therefore delever the balance sheet in a very significant way. So I think that just makes the company and the business that we're running that much better. And I'm confident in our ability to, I don't know what the gold price is going to be, but I'm very confident in our ability under Darren's leadership to deliver into expectations from a production and a cost basis. So I'm looking forward to 26.
Q3, could you give us some key figures and key takeaways from the quarter?
Yeah, I mean, Q3 was a great quarter for us. Record production at over 230,000 ounces of gold, giving us an indication of what we can kind of look forward to and maybe even more, because that did not include any gold production from Valentine. And of course, we had first gold come out in September. We're really starting to ramp that up. We've announced that it's gone to commercial production, which is roughly 80% of the nameplate capacity. Q4 is probably not going to be a representative of Valentine's run rate because it's still ramping, right? It's still going through that process of understanding all the nuances and intricacies of the mill and the mine and all of those working in tandem. But with Valentine fully up and running, I mean, you're talking about adding another probably in the order of magnitude of 30, 40,000 ounces to those numbers, right? So when you look at a $4,000 gold price environment, significant amounts of revenue generated every quarter. And now the focus of our business is what can we do to optimize the business from a cost perspective? Whatever we have control over, we have to do the best we can to eliminate waste from the business to help reduce our operating costs, but not at the expense of the business, right? So we're always looking at ways to improve and eliminate waste. And that's a directive from Darren, because Darren, 30 plus years at Newmont, where he optimized assets all around the world for Newmont, became very, very good at it. And so myself as a shareholder, as executive of the company, I'm very excited to see where this goes. I mean, there will be inflation that will impact things, but there will be ways to offset that inflation. So I can't recall, we were a little over $1,800 all-in sustaining cost an ounce, I think, just off the top of my head. And I think that presents, reasonable where we're probably going to be in that $1,800, $1,900 an ounce in 2026. But yeah, no, so I think that was a real inflection point in Q3. Ramping up more ounces and seeing the mine and mill working a little better at Greenstone, we should see some benefits of some continued optimization going into Q4. But again, we were fortunate to be able to eliminate some debt from the business. In October, we paid down $25 million of the revolving credit facility. We had some converts that came in, and so that's kind of an indication of where we're going in the future, is continual deleveraging, the business will generate a lot of cash flow at these gold prices, and will obviously rapidly delever the balance sheet.
And the financial position in terms of debt, cash.
Yeah, we talked a little bit about that in the intro a bit, but yeah, our financial position again, it continues to improve, because what's happening is we're bringing on and we're optimizing assets to have more production at a little bit lower costs. So obviously that leads to better margins, especially at these gold prices. So I think in Q3 we had about $350 million in cash, which did not include. So that was at a point in time, September 30th, the end of Q3, we had $350 million US cash. That did not include the proceeds from the Nevada asset sale transaction that took place with Minera Alamos and closed just at the beginning of Q4. So that brought in another $90 million of cash and some equity in Minera Alamos, which we're happy to be shareholders of and see the continued evolution of Pan Gold Rock in Nevada. So it's exciting opportunity for those folks. But you use that number, you're at roughly 450 million in cash. At the end of the period there, we had roughly 1.5 billion debt. So roughly a little over a billion, $1.1 billion of net debt. And that's where we're at. So the focus going forward is really to delever that balance sheet to provide the financial flexibility, because we do have our Valentine phase 2, which we're going to self-fund through the construction of that. We've got additional organic growth opportunities, which I'm sure we'll get into, which again, we should be able to self-fund all of this.
In the past, referred to exploration to Equinox, an exploration company with billions in revenues. So could you give us some color, although the budget might not be set, on next year's exploration plans? Roughly how many meters sort of goes to reserve replacement drilling? Do you do any greenfield or more? Well, I guess more exploratory exploration.
Sure. Well, you said it right. We're an exploration company backed by billions of dollars of revenue. Really, at the heart of who we are, we're an exploration company trying to discover another new deposit. And fortunately, we don't have to issue shares to do that, right? Well, let me ask you, as an investor in this space, you've followed the space pretty well. You know it well. What gets you excited about putting your own money into a what we'll call it a junior or a mid-tier gold producer? What is your what drives you to do that? Is it the excitement that could come from a drilling campaign? You believe that the gold price is going higher. Somebody's made a discovery and it probably has a positive impact if they find more. It's probably all of those, right? Yeah. And the reason that is because exploration companies, when they find something, it drives share price performance. It really does. We've seen it in many instances. And so that's why we say we're an exploration company backed by billions of dollars of revenue, because majority of our drilling will go to discovery drilling. It'll go to finding new resources, expanding resources, because that's excitement. That will drive valuation, right? And because we believe that we've got some great opportunities at Greenstone, we've got some great opportunities at Valentine, and then across the portfolio. From a geological prospectivity perspective, the best place to find more gold is at a gold mine. I'll give you an example. At Valentine, 90% of the drilling over the last probably now 15 years has gone to the 3-pit mine plan, which is about 6 kilometers of a 35-kilometer belt. 90% of the drilling has gone to that. Why? So you've got your discovery and your delineation drilling, but then you've got your infill drilling to increase confidence in the product. So we are just now starting to step out. And, lo and behold, Calibre, that again merged with Equinox, had a discovery made about a kilometer outside of the 3-pit mine plan. And we're drilling that now. I think we've got 4 or 5 drill rigs on that now. So that's resource expansion, discovery. I think that there's an opportunity within the overall portfolio of Equinox. And again, we'll spend $80 to $100 million across the portfolio next year. and that's probably a start. We'll see where it goes, because that's where the real excitement and opportunity for share price performance comes from. It's obviously delivering into expectations on the production and cost basis as well. But if you find a new very high grade underground deposit that could be a game changer, that's going to drive share price performance.
So I guess, I mean, obviously, if you make a very significant discovery, you will put that out. But otherwise, I wonder, how will you generally, communicate your exploration program and drill results to the market? As you're of that size that not everything
Yeah,
is material that would be
that's
material
fair.
for a
No,
junior.
that's fair. Yeah, and I mean, I think we'll probably be pretty regular communicators of our exploration programs, especially if they're really good. I'm kidding. I'm kidding. No, but realistically, like, as you said, what's material and what's not material will come down to what our exploration geos and operating team feels that are important to get out to the market. But also from my perspective, you know, as we have results, maybe some are outside of resources, they have potential to expand, they have potential to become economic. We will be talking to the market about that. I think that's a very important aspect. It's not just about how the operations are performing from a cash flow and a business perspective, but take a biotech company, for example. They often talk about their research and development. Well, a mining company should be often talking about not only the ways to improve the business, but exploration, what the potential is, what it looks like. So I wouldn't be surprised if we're once or twice a quarter talking about some of the initiatives going on within that space.
And Greenstone, your flagship asset, could you give us an update on the asset and its performance?
Sure. Yeah. Greenstone this year, as I mentioned, is going to produce somewhere around 220,000 ounces, which is the lower end of our production range. So upon closing of the deal in June, Darren really took a stance of resetting those expectations at Greenstone. They were higher expectations, and this is really coming from Darren's experience, right? Like I mentioned, he has over 30 years of big open pit operating experience, and what he's very, very good at is making the business run efficiently and effectively. And he knows what good looks like, and he knows how to optimize things when needed. So we've made a number of improvements. So now, for example, in Q1, the total material movement out of the mine, drilling, blasting, hauling material, was about 130,000 tons a day. I think that the company was expecting to be around 180,000 tons a day. Various things went into that, but with Darren and David Schumer, who's the Equinox COO, we've been able to identify things, work with the folks there, bring in some support. We're up to about 200,000 tons a day now, and that's very important for the mine to get to that, nameplate design rate of where it was expected to be. We think that we can actually push that material movement a little bit higher, and then start to look at what we call a grade tonnage curve, where you can pick out the best grades to put that through the mill to maximize your net present value and maximize your production and cash flow. So, we're seeing some optimization on that front. The effectiveness of how the team is utilizing the equipment they have, minimizing dilution. So you don't want to pick up too much waste with the ore rock within the operation. And then we've been identifying and seeing some things within the plant that can be optimized as well. I mean, the plant, for example, was designed to run at 27,000 tons a day. So tons of rock going through that plant on a daily basis. We haven't got there on an average quarter basis of 27,000 tons a day yet. We've been doing 23, 22, 24s. So we're not quite there. And there's some things that the team is working through now to allow us to hopefully get there in 26. But that's an opportunity that we still see in front of us. And I'm sure with Brian Wilson, who's VP Operations Greenstone, David Schumer, and a number of the team here will unlock that and get the full potential there. So things are evolving. Things are getting better at Greenstone. We're seeing the progression. If you look quarter over quarter on the production and the cost basis, you are seeing an improvement. I think we'll see a material step change in Q4 that'll set us up for 2026, somewhere between 250 and 300,000 ounces. for 2026.
Do you have any sort of base case for what kind of ISK that one could expect in an interval?
Yeah, I mean, I don't know where we're going to land yet. I mean, everyone's working through the numbers, and it's fairly complex because you're moving a lot of material. You've got inventory models and what. But I think something reasonable, like something between. I know it's a bit of a broad range right now, but something between, call it $1,800 and $2,000 an ounce is probably where the all-in sustaining cost will land, in that ballpark.
Perfect. So let's move to Valentine's, which arguably is your second most important asset, or will be. So you poured your first gold Dory bar. Could you give us an update on Valentine?
Oh, sure, sure. I mean, we've talked a little bit about it on a high level from first gold in September, reaching commercial production here a couple weeks ago, which is fantastic. I mean, it really doesn't mean anything from a I guess a business perspective, because what we want to do is we want to get that operation to what we call nameplate. So nameplate of material movement, nameplate of processing, and the processing plant smaller than Greenstone, but still 6,800 tons a day should be going through that plant. And I think last metrics that we put out were about 5,400, 5,500. And that's really, really encouraging to see in such a short period of time, from first gold to declaring commercial production, which is roughly 80% of nameplate. It's a testament to the human capital, to the team there. They've done a great job of identifying risks, being proactive. And that really starts with the leadership and Darren and his operating expertise, because he brought in a team well before, an operating team well before the construction was completed. Gentleman's name, VP Operations of Valentine, is Jason Sear. And he's done a tremendous job of overseeing and helping oversee construction to dovetail with the operations. You think about it in kind of a client relationship. Jason, as the operator, he was the client of the construction team, so he could work closely with the construction team and say, hey, this is how we need this, and this is the angle, or we need this piece of equipment because I don't think this is going to be the right one. So now that operating team and the operation can be set up in such a way that it can perform to its design in maximum capacity and most efficiently and effectively. And because of that, we are seeing the benefits of this ramp up. So Valentine's performing quite well at the moment. Not only do we have that exploration potential, but the operation next year should do somewhere between 150 and 200,000 ounces. Remember, this year was zero. So that's that whole inflection point we're going through of we're no longer, putting out cash. We're now making cash. So that's a great place to be as we continue to unfold and evolve as a business. And that's what we're excited about, really excited about in terms of the whole valuation and opportunity, bringing on more Canadian production, in a safe tier 1 jurisdiction. You trade at a less of a discount. So Valentine, things are going well. Something will come up, Jasper. We're not naive to the fact that we will have some type of a hurdle, some challenge will come up. That's just, what we have to be prepared for and deal with. And that's why we have great people in the business to be able to be proactive thinkers and reactive when need be. But no, I mean, 2026 should be an exciting year at Valentine from an exploration, from a production, from a ramp up perspective. And at the same time at Valentine, we're also progressing a phase 2 mill expansion, right? So the original design here was for Valentine's process plant to be set up to process 2.5 million tons of rock a year and produce somewhere around 175 to 200,000 ounces life of mine average. Okay. And that feasibility study envisioned that it would go from 2.5 to 4 million tons. So it would require some capital in, say, year 3 or 4 to add on to the plant. If we had done things a little differently, we probably would have stepped back and said, let's look at a larger operation. Rather than go from 2.5 to 4, should we be designing something for exploration success? Because we're already finding more, I shouldn't call it ore, but more gold that could be economic. We acquired the asset when it's 50% through construction. So there wasn't a heck of a lot we could do Foundations, footing, design had already been set. But what we have done is we've taken a look and said, well, what could we expand it to? So the vision now is to expand it to 5 million tons versus the originally designed 4 million tons, which should help us not only obviously from a throughput perspective, but it will likely lead to additional production down the road on an annual basis. What is that, 10%? Is it 15? Is it 25? We don't know yet. It'll come down to optimizing mine plans and sequencing and putting that through the plant. But we will likely start that phase 2 work this year versus what was originally designed 3 years after commercial production. So that's an exciting development as well. And there'll be some key catalysts coming up over the course of the next couple of months where we will be talking more about Valentine's growth potential.
And also, yes, finally, could you give a rough sense on ballpark range of the all-in sustaining cost expected for next year?
Yeah, Valentine, I think the study was quite a bit lower. And studies often, technical reports, and they're often where they torture an asset until it confesses an answer that a management team wants. They torture and torture and torture. Sometimes not all the costs should be properly reflected in those reports. But when we look at it from an operation, we need to make sure that we operate it responsibly. We need to make sure we're in front of a lot of things. So I think next year we're probably going to be in the ballpark of $1,350, $1,400, $1,450 all-in sustaining cost range. So, a nice profitable asset for us, especially at these gold prices, is going to generate tremendous amounts of cash flow. And again, another asset to allow us to rapidly delever that balance sheet, put us in a great financial flexible position. And, if we step back and we look out 12, maybe 18 months from now, assuming this current gold price environment, we may be in a position where we have, a net cash versus net debt, and be in a position where we're self-funding all of the growth within the business, but more importantly for shareholders, potential for possibly a dividend, a share buyback, or looking at some type of a return capital to shareholder basis. So it's exciting period for all gold companies right now, but particularly I think for Equinox as we go through this inflection.
So let's move to your Nicaragua operations, and you had a very strong quarter there, 71,000 ounces produced at the little over $1,500 an ounce all-in sustaining cost. What contributed to the strong production increase?
Well, Nicaragua has been a great little cash flow engine for the business. And, a fun fact, the Q3 for Equinox in Nicaragua, a little over 71,000 ounces. That's a record for those assets. That's a record amount of production generated out of those assets. And it's really quite interesting. If you pull it back to 2019, 2020, now, just as a refresher, there's two mills there. There's one at an asset called Limon and one at an asset called Libertad. And combined, the company processing power it's about 2.7, 2.8 million tons of processing capacity a year between the two plants. They're separated by about 250 kilometers. But what Darren did at the time was he really broke down the barriers between the two entities and the people and the employees and the operators, and started to look at, well, could we bring material from Limon or other satellite deposits within the country and haul it to either one of these mills? We started doing that in 2020, and we were producing about 125,000 ounces a year. And we had, I think, about 100,000 ounces in reserves. But because of the change in that operating strategy and the structure that Darren set up, we were able to quarter over quarter over quarter responsibly bring on more production. And so what contributed in Q3 was the evolution of that hub and spoke operating strategy, utilizing the two mills, and also, some of the grades we're getting in Nicaragua are very high grade open pits and undergrounds. So the contributions coming from a solid team there. Jesus Rivera, the VP of operations there and VP of all of Nicaragua, has been doing a fantastic job. And so I think that Nicaragua is one of those opportunities, and if you invest in the development, if we continue to invest in exploration, which we have full plans to do, I think we're going to see continuous optimization there over time. I mean, there will be times where it's up and down because it is fairly variable on the grades and the different sources that come into the plants. But here's an example. I mean, we had 100,000 ounces when we first started in 2020 of reserves, right? Of reserves. At January of this year, those operations produced just over 1 million ounces of gold, and the reserve base at the end of 2024 was 1.1 million ounces at a little over 5 grams per ton gold, combined with open pits and undergrounds. So, we've had some great success with exploration, which has contributed to that production, which has contributed to the cash flow, which has, evolved that whole hub and spoke operating strategy. So it's been a fantastic operation and continues to do so, as you saw by this over 70,000 ounces of production.
So it is fair to say at least that there's no reason to believe why Nicaragua next year should produce, a minimum, say, call it 200,000 ounces as a minimum.
We'll see where the costs come in because we're always continuously mining and bringing on new production. But I think it's reasonable to think it'll probably be in that $1,600-$1,700 ballpark figure.
Is there any other asset that you would like to mention or give an update on?
Well, we talked about this last time, and I think it's worthwhile talking about is the assets in California. So Mesquite, it continues to, it's a very mature asset. It continues to go along. We are drilling there. We see some opportunities around Mesquite, but the real gem and jewel with California is the phase 2 potential with Castle Mountain, right? And Castle Mountain, it was a heap leach mine. It's really on residual leaching now, and we're going through the permitting process. And within the United States, we got put into the critical minerals category, so we get put into this Fast 41 track now. So it's really a definitive of timeline where the federal government will give us a record of decision, and that is expected to come in Q4 of 2026. So that's exciting because California right now produces around 75,000, 80,000 ounces a year from Mesquite, whereas by bringing on Castle Mountain, which is an expansion of an existing operation within the footprint of the current mine plan or the mining permit, that asset could produce up to 200,000+ ounces a year. So we've got some great organic opportunities within the portfolio. We're not looking to go out and acquire any new assets. So there's some opportunities there as we continue to progress along. And this also dovetails to the timeline and sequencing of things, right? We're ramping up Valentine. We're going through the phase 2 now, ramping up Greenstone. So between those two assets, we should be in the 400,000 to 500,000 ounces a year of annual gold production coming out of Canada. And of course, at these metal prices, we can delever the balance sheet quickly, putting us in a financial position to then look at a capital and a construction of Castle Mountain being self-funded through operating cash flow. So an exciting time. And then finally, I'll touch on Los Filos, an asset that we all believe has fantastic opportunity and potential, located in Guerrero, Mexico, and currently is on suspended operation as we work through hopefully the final land agreements. We've got 2 land agreements in place with 2 of the local communities there. We're working on the final with the 3rd. I do believe that we're seeing some progress by both parties, and I think we'll get there. I do believe so, but we're doing everything we can to be as respectful as possible. And if we get the land agreements, you could potentially look at Los Filos coming back online as a heap leach operation. I'm not 100% sure if that's what we'll do, but that's what it was as of the beginning part of this year and the last several years is a heap leach operation. But what it needs now, really what it needs to unlock its full potential, is a process plant on site versus a heap leach operation. And a process plant there, I'm not sure, but we're going through all the technical studies now, CapEx refreshing, operating costs refreshing, but it's probably somewhere in the $500, $600+ million range CapEx to build that facility. And upon doing that, that asset could produce between 250 and 300,000 ounces of additional annual gold production. And I'm going to say that it's probably going to be around the $1,500, $1,600 all-in sustaining cost ballpark. So again, a very exciting opportunity for Equinox. Things we've got to work through with anything, but I think under Darren's leadership, I think we'll find common ground, and I think we'll take the right approach. I know we'll take the right approach. So some additional opportunities in the company, but opportunities that I think could really lend themselves to stronger valuations as we de-risk these things going forward.
You have already touched on this a few times, but I think this is such an important question that it's worth having as a standalone question. So could you explain the key capital allocation priorities?
Oh, sure. And it just because I say this today doesn't mean they're set in stone. These could change and shift with events that are happening. But the key is ensure we invest in the assets to reasonable levels such that we will have sustainable operations going forward. Invest capital into all things with the operations, not just equipment or the plant, but stakeholder engagement and working with our communities, and also, as we've talked about, exploration. So, I mean, we talked about the quantum in terms of dollar amount for exploration next year, and that could come up depending on results, right? So that's important, but a priority here, of course, will be delevering and paying down debt in 2026 and 2027. A priority will be advancing the opportunity at Valentine Phase 2. Where's the capital going to end? I don't know for sure, but you're probably looking at about 200, maybe 250 million to take it from 2.5 million tons to 5 million tons a year. So capital allocation there to open up additional opportunities for future production growth, and I think that's going to demonstrate a very high return on investment. It's going to demonstrate a high NPV, and we're always using the lens of a much lower gold price to ensure that the allocation of capital is the right one. Today we don't know, but the goal is to make the least wrong decision that we can make by looking at it from various perspectives. You have a perspective, shareholders might have a perspective, a board member might have a perspective. So we're always looking at triangulating those aspects to make the least wrong decision. But so Valentine, investing into the asset there, we will have some capital allocation strategies going into the other operations, and I think that from a big picture perspective will set us up for 27, 28 as we continue to hopefully self-fund growth at some of the other assets in the portfolio. It's a great place to be, really, because we do not have to look for acquisitions to be more sustainable or to generate growth for our shareholders. So it's a very exciting time.
Awesome. And so with the run up in gold price, has your view on M&A changed in the past months? Could we go for acquisitions and divestments?
From our perspective, I mean, we're on a bit of a track here already with some divestments, right? And that could continue. We've had some inbounds on some assets, and if something made more sense for our shareholders in someone else's hands, i.e., we get some value for it, divest of something, potentially putting us in a position to expedite the debt repayment or whatever, then we'll look at that pretty closely. For sure, there's no doubt we would do that. And as I say, we've had a couple inbounds on things from a divestment perspective, so we'll see how that track continues. On the acquisition front, there's nothing at the moment that is compelling enough for us to acquire, even at these metal prices, because of the organic growth in our portfolio. Again, we're talking about potentially another 200,000 ounces that could come online in North America, putting our company at somewhere between 650 and 750,000 ounces out of North America. That's an unbelievable place for a precious metal company to be. And I would believe that probably starts to really push us towards, some of those top value quartile gold producers like an Agnico and an Alamos. We are starting to track amongst those companies, and so we don't need to go out and do any acquisitions. And I think we would be doing a disservice to our shareholders if we did that, because we're still trading at sub one times price to NAV. If we were trading at 1.5 or 2, you've got valuable equity to then go out and look at some things. But until that happens, I think that we'll preserve those opportunities and continue to focus internally. Mergers, a different story. Maybe there's opportunities there. We haven't seen them yet. We haven't seen. We've just completed one that is still in the process of creating value. So I think heads down, focus on delivery, focus on the right capital allocation and potential divestments. And I think that again in the next 12 to 18 months at these metal prices, we could be in a position such that we're returning capital to shareholders and we still have internal great growth for share price performance.
So with that, where do you envision Equinox Gold at the end of next year?
Yeah, I mean, again, it really does come down to gold price, and I can't control gold price. Maybe you can, and that would be helpful. No, where do I envision? I would envision, we continue to optimize assets across the portfolio, be really focused, be really disciplined on our capital allocation. Do everything we can to make the least wrong decision. Hopefully, we've put a very significant dent into the net debt position of the company. And again, if we have 4,000 through 26, I think we'll be in a fantastic position to potentially be net cash, in a net cash position. And if we're really lucky, we've had some success with exploration along the way, which could contribute to some excitement within the business. And that would be a great outcome for us. We don't. It's not. I'm not here to promote, but I'm here to talk transparently about what we're capable of doing, what the business is capable of doing, and I think that we just have to focus on that and deliver into commitments, and we'll build the trust of the market, and that will give us the outcome that we're all looking for, and that is better valuations.